Welcome to my channel. I'm Dr. Romano. In today's video, we are going to be discussing what is the difference between a larger hedge fund and a smaller hedge fund, and which is better, which makes better returns, and which hedge fund is a better source of returns. It's very important. Now, for those of you who don't know what a hedge fund is, that is an investment company, just like a investment bank, but it's a little different. They focus on one particular type of investment, particularly for smaller ones. And that would be, let's say, the long or short equity markets, for example. And they place bets on that market, either yes, it's going up, or yes, it's going down, just depends. And whereas an investment bank, that's a conglomerate of different type of companies all merging together. So you'll have the IPO desk, you'll have the mergers and acquisitions, you'll have the trading groups, and so forth. It's such a big company. But a investment company, think of a boutique retail shop. They only have one type of clothing. Well, that's a hedge fund. And the history of the hedge fund, it was coiled in the 1950s and 60s, that term. And what it was is it was basically a company that was hedging their bets. Today, there's many types of strategies and many types of markets that hedge fund traders invest in. So not everybody can invest in hedge funds. You'd be a certain type of investor with a certain amount of wealth. That depends every year. I don't know what it is this year, but typically you have to be worth at least $1 million or more, or you have to make at least 200 something to 300,000 a year. So it just depends what is going on based on the SEC and what are the regulations. I would hope that the SEC lowers that amount and allows the average person to invest in hedge funds. Now, of course, you are not a doctor like me that knows how to select a fund and deselect a fund, but I would definitely like to see in the future the public somehow having access to hedge funds. And the best way to do that is through a funds of funds. So you put up money in a funds of funds, you become a client, and then the funds of funds is the one that selects all the hedge funds in their portfolio. That is actually the best way to invest in hedge funds, because you can't put all your eggs in one basket. I wrote a book about that, and the front cover was a bunch of golden eggs. Before we continue the video, please remember, if you want to say thank you, Anthony, because you enjoy my videos, please do thumbs up. It's right there. Thank you so much. I really appreciate it. And so, based on what I've learned and what I've researched in my Ph.D. research, and after that, what I researched and what I continue to research, there's just so much to research and to analyze. It never stops. You have to say to yourself, some people think that hedge funds are not outperforming investment banks or mutual funds. That's a load of nonsense. There's thousands of hedge funds in the world, in excess of 15,000. We don't even know the real number, because some hedge funds, they don't even register because it's a private fund. It could be someone's money. One person's very wealthy and they create a fund. We really don't know the actual number, whether it's 50,000, whether it's 25,000, and not all hedge funds report to the same hedge fund databases. So in order for you to find a hedge fund, you have to spend thousands of dollars to join these hedge fund databases, where certain hedge funds will report their data to, and they'll have like an account with them. But not every hedge fund is on every hedge fund database. So that's another issue. So hedge funds are very hard to find. And then once you find a couple dozen, which ones do you invest in? These are all questions that I have to answer. I'm going to focus on the difference between a larger hedge fund and a smaller hedge fund. A larger hedge fund, I believe, it has an excess of AUM of, let's say, $1 billion. That's a large fund. And it could go all the way up to 200 billion. When you understand trading and when you understand position size, based on my research, when the position size, in other words, position size is when you invest in, let's say, IBM and you spend $1 million. That's a position. And you are betting whether it's going to go up or down. So if you go long, it means it's going to go up. If you go short, you're betting it's going to go down. Or you could use a different strategy like certain option strategies that it really doesn't matter if it goes up or down. As long as it stays in that range, you're going to collect the premium. Based on a larger hedge fund being, let's say, in excess of $1 billion, their position size starts to get pretty big. Larger hedge funds in excess of 20, let's say 10 billion, 5 billion, they already have hired traders to work in their trading group. And they are copying the exact same thing that an investment bank does on the trading floor. I know because that's where my experience is. I used to work at the investment bank on the trading floor for risk management. I got a full exposure to the profit and losses at an investment bank. And my job was to review those losses to make sure they were accurate, make sure they were submitting their data on time, and to investigate why they were losing so much money. As for what I seen at the investment banks, those position sizes were enormous. Yeah, you had 10 traders, 20 traders trading a lot of capital. Once a larger hedge fund is trading in excess of $1 billion, we know that their position sizes start to get bigger. And to the human mind and the human brain, that's a lot of work. Now, of course, if you have an algorithm doing that for you, that's still a lot of work because the human mind and a programmer still has to tweak it continually. That's what a large fund does, and they could have an excess of 100 people, 500 people working there. It just depends on the company and the type of strategy that they're trying to make a profit on. Smaller hedge funds are, I would say, in excess of $500 million, under $1 billion, let's say. And it is hard to get started, but once you have a track record, then you have a proven track record of how much you're doing over 5 years and how you manage that risk over 5 years. And that's your track record. And so if you're going to start trading with $3-4 million, I don't think it's going to be enough to pay your attorney, administrator, and the hedge fund accountant and the audit company. And so that's why you need in excess of at least $5 million just in case you have a bad year and your returns are not what it is for other years. I'm not saying that you're not capable of making 50, 60, 80%, 100% return in a year, but what if you don't make anything and you're down a certain amount? You're going to have to come up with that money to pay those people. And remember, smaller hedge funds, there really is no reason to have employees because you're the trader. You are putting the trades on the market. Yeah, you need a trading platform and a brokerage house, but it's still a small company because you're there trading all that capital. Once you have an excess of $5 million, then I highly recommend you create a hedge fund structure and you create that structure that's needed to find capital. And so that's how you start. Now, once you get up to 50 million, 20 million, that's considered a good size of a hedge fund. That's called AUM. And at 50 million, 20 million, then you could start marketing your fund to family offices, investment banks who invest in hedge funds, etc. Once you have the track record of at least 5 years and you have a proven return, a decent amount of returns, of course, if you're making 6%, 7%, that's not really lucrative. It's not very attractive. Now, based on my Ph.D. research, you have to do really well when there's certain types of markets. And that's proving yourself to me. Let's say in 2020, that was a bad year. but it was a good year. If you understand risk management and you applied your risk management to your trade, which I'm sure at this point you are doing that, and from there you start placing those trades, you're making money, you're doing great, and you're raising capital. Put it this way, if you could get past 50 million, you're doing pretty good. Because once you hit 50 million, you're going to go to 100 million, and then 100 million, you're going to go to 200 million. Just based on compounding interest. Now, as you get bigger, the smaller hedge funds are going to have a problem with finding more stocks to invest in, more opportunities. As the bigger they get, they're going to want to find more clients. And so not only is the hedge fund manager there doing the trading, doing the marketing, taking care of the legal situation, dealing with the administrator, dealing with the accountant, etc., and making sure all that's being taken care of. It's easy to trade because your position size is small, under 100 million, or even 50 million. Hedge funds out there that are 50 million, they could do really well. The difference between a larger fund and a bigger, smaller fund is management. The head trader is the owner of the company. They're the ones doing everything, and they're the ones proving themselves to their clients. I highly recommend, if you want to create a really nice, smooth track record, you stay small. Stay small, under 100 million. Once you find $100 million worth of capital, or you get to that point, stop looking for capital. Keep your position sizes smaller so that you could outperform the market and other hedge funds that are larger. From there, you'll reach your 500 million, and then you're going to realize that around 350 million, something's going to happen. It's going to get harder to get in and out of those trades, and it's called being nimble. And then when you're not doing so well, you could lose clients. So it's going to be this up and down roller coaster ride trying to find new clients. This is why I say stay small, keep the same clients, create relationships with those clients, because when they start from the beginning, they will stay with you throughout that decade or a 20-year period if they're young investors. That is a major difference between larger hedge funds and smaller hedge funds, is the position size. And according to my Ph.D. research, smaller hedge funds somehow always outperform larger hedge funds. That's just a correlation. I did studies on the size, the age of the fund, the strategy, the markets they're trading in, what type of market it was that year, whether it was 08 and 09, what was the volatility like. I did a lot of research. And that's all scholarly written research, peer-reviewed, etc. I'm just not doing research out of a magazine or going on the internet. No, all that research had to be done through scholarly written journals by PhD graduates, and they were peer-reviewed. All this information is peer-reviewed, etc. Then I had to take thousands of hedge fund returns. I had to take a sample of a population for every single type of issue that I was looking for. And that's where I get my data. You want to say to yourself, how am I coming up with this information? Oh, you have to prove it with charts? I'm telling you, this is my research. And so what's the difference between a smaller hedge fund and a larger hedge fund. And as an investor, if you have 10 million, 20 million, or even 5 million, you want to focus on those smaller hedge funds. Do not go looking for bigger hedge funds. Because you have to remember, if you only have 10 million, you can't put 10 million in one hedge fund. It doesn't work like that. You have to spread your risk out. Yes, the hedge fund manager is able to manage risk if they're in business for 5 years and they've dealt with a market collapse or a high volatile market. However, you're going to be needing at least 10 hedge funds for your portfolio of 10 million. And some hedge funds have a minimum of $1 million or more to invest. Some are 150, some are 250. It just depends on how the attorney created that fund. Now, in that case, since you're not an expert on investing in hedge funds directly, I highly recommend that you find a funds of funds. That is a company that has created a portfolio of hedge funds. And so since I'm a doctor of hedge fund selection, I highly recommend that you focus your assets on investing in those funds of funds. Because it's better to let a professional select and deselect a fund than you try to make a gamble. Because just because there is a hedge fund manager out there and he did 100% in 1 year, it doesn't mean that the next year or the next time there's a high volatile market that he's going to do 100%. It just depends the type of market, the age of the fund, what's the AUM. This is why those new hedge fund managers out there that have a track record of 3 to 5 years, they're doing really well. But yet, they haven't experienced a market collapse yet. But because of their position size and the fact that they don't have a lot of clients, they're more focused on what they have to do, and that's trading. Secondly, because they have a track record of 3 to 5 years, you could guarantee you have to ask, well, what did they do before they were trading? Well, they were probably trading their own capital, or their family's capital, or their spouse's capital. So they have even more experience. This is why I say stay away from larger hedge funds. My previous video that I posted, it discusses what is going on in the hedge fund industry. Why are their returns being watered down? Because the investment banks are now allowed to invest in hedge funds. And so again, that's why you should be focusing on smaller hedge funds, because you have kind of an upper hand, because those large investment banks are probably focusing on those larger hedge funds. But I hope they don't ruin the industry and start investing in only little funds, because these little funds will get just as big. And then your returns will get watered down, and you will find it harder and harder to find new clients. Because a client doesn't want a 7% return. Clients want to see larger returns, 20, 30, 40%. And if you could create a 20% in a market that there was nothing going on, you're doing pretty good. And so I want to thank you for watching. Please remember, if you like my videos, to subscribe to my channel. Do thumbs up. It's down there if you want to say thank you. And please remember to send me messages to the live chat. I will respond to you directly there, or I will create a video just for you. And please, if you have friends that want to hear about these types of videos, please use the share button and send it to your friends. Thank you so much for watching.